What is the bond market telling us? The bond market is the truth. Bonds are mostly seen as boring. My grandparents invested in bonds, so they had to be conservative and low volatility. Yet, bonds are the foundation of global markets. They represent the building of a company, municipality, or a country's foundation. The United States uses treasuries to fund the administration and upkeep of our country. A municipality will issue bonds to build infrastructure, roads, bridges, etc. So when we see bond yields rise, the value of the bond goes down, I get concerned. This is the yield curve. It is a comparison between the 10 years Treasury and the 2 years Treasury. When the yield curve inverts, this is indicating of an economic slowdown. Since February 2021, yield curve was at 1.58 to today it's at -0.91. The yield curve inverting represents a recession is on its way or we are in one. With the Federal Reserve raising Fed funds rates, which drives the 2 years Treasury yield higher, investors exit the shorter end of the curve and buy the longer duration bonds, 10 years Treasury. Today we are at a point that you have to ask yourself, if the Fed is going to continue to raise rates, which benefits money market funds, why would I risk my principal value by staying in bonds? Why not just move my money to money market funds and have zero volatility of my principal? As of February 6, 2023, there is $1.2 trillion in retail money market funds. You can see the move from equity and bonds markets since May 2022 is pretty significant. Housing. Even though every real estate agent in my area tells me the housing market is solid, they keep lowering prices. The homes that are for sale stay on the market longer and longer. 30 years mortgage rates continue to move higher because the underlying benchmark, 10 years Treasury, inches higher. As long as the Fed raises Fed funds rates, financing a home purchase will continue to get more expensive. Today the Federal Reserve's Jerome Powell said that due to the data that is indicating a continued rise in inflation, they will continue to raise rates. We should expect key areas of the economy to continue to slow, such as in housing, consumer spending, and an increase in car loan and credit card delinquencies. High-risk stocks, tech as an example, typically don't do well in slowing economies. Yet they have done well so far this year, but I have a strong opinion about why they have gone up. I hope you have enjoyed this video. Please press the subscribe button and like this video. Join the Best of US Investors Discord along with subscribing to Platinum Swing Trading Channel or the QQQ Trade Ideas newsletter by clicking the links in the profile section below.